Well, let's continue with this discussion on working capital management. We just stopped at this slide here on some applications of level production and management decisions. So we have here we have the examples of Briggs and Stratton Corporation of seasonal sales. That's the type of business we want to apply seasonal production to. So we have sales are lowest in July to September quarter and peak January to March. So first quarter, because we have these fluctuations in sales, generates negative earnings per share. You don't sell enough, you don't make enough profit. But then the next period, you are going to make up for this loss and produce and make more profit. And you see, this is how the seasonal production looks like in a graphic format. High production, high sales, low, fluctuates. Okay, the same for, you see, earnings per share matches the pattern of sales. So also we have in retail, Target and Macy's, they have to deal with seasonal type of production, and they have uh, the peak season for them is in during holidays. Actually, lots of retailers sell almost half of their sales during in the fourth quarter, November to January, and this is when they use up the build up in inventory if they go with season production and with level production. And in the graph format, this is how it looks like. You see, we have again seasonal production, peak and lows, and here we have earnings per share that match that. Now we have looking into how to move into level production. These days, computers remember, they have codes. And they remember quantities, prices, sales, dollars, amounts, so it's a little easier to keep track of the sales, but you just have to summarize them, put them all together, which is can be done with in the computer area, digital products and scanners. So then you look at the patterns of you have to become, as a manager, become very familiar with the patterns of your sales, inventory build-up, and then see how you can do a good forecast for the future, so you don't have to deal with too much of the build-up in inventory. So you have to do a little bit of analysis of your past sales patterns to engage in your forecast for the future. So for this example, a motorcycle company, of course, that's a seasonal type of production. Sales fluctuates, high sales during early spring and summer, and then you have lower sales October through March. If you go with a decision to apply level production and smooth out production, then you'll end up producing the same amount per month, but you have to forecast the amount for the year to calculate how much to produce every month. Okay, and let's see what they have. They come up with sales forecast for 1 year. October to September, 12 months, 1 year sales forecast. They say they're gonna sell these units per month. So you see, they have month with zero sales, and then the peak months we have May, June, July 2000, and then it starts to go down again. Now, to do the level production, you'll add up all these quantities, which they have the answer for you. If you add up all these sales, you forecast to sales 9600 for the following year, and then to do level production you are going to divide this amount by 12, and then you are going to produce an exact number, which is actually 800 per month. And then you say you are going to sell your motorcycles for 3000 F unit. That's called the price, the selling price. So if you multiply units sold for the whole year times the price, this is how much you want to make in sales for the next year. Okay, then we're going to look into the inventory buildup. in current asset management. So that's the next year, and then you start with 800, and you are going to produce the same amount every month. That's the level production. And then you analyze the inventory buildup. So here sales, this column is coming from the previous slide with the sales forecast. And now we work on the line here. Beginning inventory, produce 800, we sell 300, ending inventory 1300 units. Next month, we have this one is going here. We produce the same. Then we sell a little less, we have more inventory. Whenever you sell less than how much you produce up to this point, your inventory is increasing. When you sell from here to here more than what you produce, your inventory is decreasing. That's the so-called inventory buildup. So you see how it goes. You sell, this is your sales forecast for each month. Then you calculate inventory buildup per month. Now what you have here is the cost in dollars per cost of production in dollars corresponding to this inventory. So it says here that our cost per unit to produce this one motorcycle, it cost us $2,000. So to calculate the cost of inventory, we multiply the units, this is in units, times 2,000, and this is how we have the cost of inventory here. This is how the numbers come up. So we look into the inventory buildup during 1 year, every month. Again, it's decreasing up to this point when my sales are less than how much I produce, and then it starts to decrease because then I sell out of this inventory buildup. So this is how we have a visual representation here on my current assets buildup. Cash, we have, now we look on the column, the cash starts from 0.25 million, which is really 250,000, and it stays pretty much the same. And then we have more buildup in cash up to September, which is 2.85 million. Accounts receivable, 450,000, it goes down, then it starts to go up and down, it fluctuates. Inventory the same, starts 2.6 million, goes up, and then it goes down when you sell a lot. And now we have total current assets, we add these three elements, and we have per month, how much do I have built up in my total current assets for the next year. So if you look here, we have fluctuations, but basically I start from 3.3 million and increasing, decreasing, and I end up with 5.2 million. It's still almost 2 million, 5.2 minus 3.3. I have a build up close to 2 million for this 1 year in current assets. That's the big picture of what's going on with my current assets grow. They grow a little bit from each of these elements. So basically, to wrap up this discussion here, the current asset management deals with current assets and their build-up over a period of time. Here I started around close to 4 million, increase, decrease, ended close to 5 million. Then that's the end of the first year. Then now we start with the second year again, build up in assets. So you see how this business grows. This is close to 8 million. And you remember from the previous slide with the split in current assets, some of them become permanent. Once you have a build up in cash, that's going to become some permanent cash. Some build up in accounts receivable, some build up in inventory. So we are going to continue next with another recording on this asset financing. Now that we understand how these assets grow, we have to take care of their financing.